Good morning, everybody. Welcome to MarketStream.live. It is May 2017. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. This is where we're going to check out everything that's hot on the open here at the U.S. markets. And the French elections have come and gone. That has been the biggest event that the markets have been hanging on to, pretty much so for the last couple of weeks. Now, yes, we've had some pretty decent earnings announcements. We've had some pretty decent global economic announcements, but bottom line is the French elections were the centerpiece, and that has come and gone. President Macron is now in power. He got 69% of the vote. It was a landslide, but it was also the lowest turnout since 1969 in the French elections. And now the markets are going to be gearing up and focusing on data. You're seeing mixed reaction across the board. It could be a little bit of the sell the news after buying the rumor type of opportunity. But at this juncture, global markets are mixed. In Asia, check out the overnight action report for Asia. Europe, were just discussing that on the open in Europe. And here in what's hot in the U.S., taking a look at the Dow Jones, you see it's up 8 points at 21,013. And really very muted. The sessions have been very muted, very grindy. For those of you that are new to the show, this is important to understand because if you look at your portfolio, whether your 401k, your 403b, your Keogh, or whatever it is, or even if you're self-directed, you're retired or semi-retired or just independently employed, you look at your portfolio and it has done pretty much nothing for the last 2 weeks. Yes, we are at all-time highs on certain indices. Yes, we're over that psychological level of 21,000. But as you can tell from this chart right here, it's just been sitting on a plateau. And plateaus for markets are not fun. As investors, as an advisor, these are times where all of a sudden, the longer that plateau plays out, the more anxiety people start to build up. Now, we haven't seen that reflected in the markets yet. The data has been somewhat, continues to be relatively bullish from the fact that we've had decent economic numbers both on the employment side, we've had it on GDP side, but some things aren't expanding as quickly as others. One thing that was notable from last week was wages. Even though we have 4.4% unemployment, that should be phenomenal. Full employment, everyone should be excited, but we're not seeing wage inflation. We're not seeing people making more money. As a matter of fact, we're actually seeing the average work week extending, but people aren't making more money. There's something wrong with that dichotomy, and we're going to have to watch that closely. But we're going to be mostly focused on the continuation of earnings results and global economic results. Taking a look at the Dow Jones, what's notable on the Dow, bottom line is blue chips have been coming in with inline or better than expected estimates. There have been a handful that a little bit dicey. But at the end of the day, it's been in line. Taking a look at the S&P 500, basically trading around just above in the green and actually ticking down now at 23.98, down 50 cents. Again, a grindy trade. There's two lines that you're going to want to focus on this chart. If you've never looked at charts before and you're like, oh gosh, think of it as just a picture. And what we're doing is we're putting things called moving averages on this picture to give us an idea of whether a market is trending to the upside or downside. That allows us to understand what the sentiment of the market is. Nothing more, nothing less, right? It's no magic crystal ball. And so you can see right here, the S&P 500 is trading above its green line, which is the 20-day moving average. Those are short-term traders, short-term bulls right now because the market's trading above it. And the 50-day moving average. This is more intermediate term. Last 50 days, looking at large institutional type of trade as well as retail trade. And then you have your long-term 200-day moving average, this black line. These lines give you context on what the trend of the market is. And clearly right now, the bulls have been in control. In other words, the market has been moving to the upside. So if you have a portfolio and you're invested in the market, in the long side of the market, this has been a positive time for you. It's a little bit frustrating because now we're in that consolidation, and you see the similar consolidation in the S&P 500. The NASDAQ is another index that we watch very closely here at MarketStream.live. This tracks the technology sector. right? So the Googles and the Amazons and Pricelines and so on and so forth. And you can clearly see, again, above the green line, which is a 20-day moving average, and the red line, the 50-day moving average. The bulls are in control. Now that bounced up after testing the 20-day moving average and being in a very long consolidation for months. So these are very grindy, tough markets if you are looking at them on a daily basis. For those of you that are investors, you're thinking, well, the NASDAQ hit all-time highs. You know, it's basically down 2 points today, but things must be going great. But this, as you look at the picture, looks to be just this grind. Now, some people like that. Others, like traders, don't. At some point in time, we're going to have a break. Whether it's to the upside or downside, we don't know. But right now, the market is in a bull trend. The bulls pretty much will have all of the momentum at this juncture. And that does not look like that dynamic's going to change unless we see a major shift in either economic data or earnings data. Now, taking a look at the Russell 2000, this is an index that measures small cap stocks that are primarily domestically centric. In other words, they're here in the U.S. So those small businesses. And they're going to be extremely sensitive to the economic data. So you hear GDP data, you hear inflation data, you hear employment data, wage information. All of these components, as well as domestic earnings, like let's say regional banks, that's all going to impact the Russell 2000. This is one of those indices that I look at and utilize to give a pulse of what's really going on here in the United States. So as you start to hear more Trump policies being debated, whether it's tax reform, medical reform, and so on and so forth, infrastructure plays, border tax components. I mean, these are all going to be things that are going to deeply impact the Russell 2000. This is an index that has not been moving to the upside as dramatically. As a matter of fact, for about 10 days, it was moving to the downside. It challenged that 20 and 50-day moving average, as you can see here, bounced up. The bulls are still in control on a short and intermediate term, but you can see that it had a short-term trend to the downside. So not complete certainty on what's going on here domestically, and that makes sense, right? Now you understand when you hear those headlines, we got the healthcare reform bill through, and the market kind of firmed up here. Well, is that positive or negative? Well, it could go both ways, but right now the bulls found it positive on Friday, and we need to see if they have some sort of conviction. So watch earnings, watch the reforms that are coming out of Washington, and this is my canary in the coal mine. So for those of you that are new, if you start to see either strength or weakness, or in other words, the Russell 2000 is leading or lagging the bigger market cap indices, that's an indication that the markets could be moving in one direction or the other, and that could be a little bit of a tip. Volatility. Now, volatility is that forecast of future potential movement. It's implied. Does it have to happen? No. And right now, the sense that there's going to be big violent moves is very low. Volatility at 10 means that basically the marketplace believes that the trend that's currently occurring, and right now the bulls are in control, that's in place. Until you start to see get up in the 20, 30 level, you're not going to see the type of fear that you would normally associate with a market that has complete uncertainty. The U.S. dollar has been stronger against all global currencies at this juncture, whether it's the euro, the pound sterling, the yen, the yuan. All of those currencies are trading to the downside, which means that international exporters are benefiting from a stronger dollar. That's going to potentially hurt U.S. exporters. So look at things like Ford, GM, and other companies that manufacture and export out to other countries. Because the dollar is strong and their currencies are weak, that's going to make it harder for those countries to buy our goods. They're going to be more expensive than what they're producing in their currency, and it's going to impact their exports. In other words, they're going to be able to export more here to the U.S. because we're going to be having more buying power. We'll be more apt to buy their cheaper products. Taking a look at the crude markets, crude oil has tumbled. It went through and actually tested the $44 mark earlier last week. A really interesting trade. This has been a precipitous drop in crude, and I have to be honest with you, if crude continues to be weak, I'm really not buying into this growth discussion. I do think that crude is a barometer for growth. And yes, we have a glut of crude. We have a lot of inventory to work off of, folks. And so unless we start to see those inventory numbers that come out on Wednesdays and Thursdays of every week, if we aren't starting to see larger and larger draws, I'm going to start to put a question mark on whether or not things are moving at a pace that's going to warrant the valuations, or at least the stock movement that we've seen. Taking a look at the bond markets, they pulled off of their best levels this morning. They're actually trading on their lows as far as prices. So when you see bond prices going down, in other words, the 2-year, the 10-year, and the 30-year, if you see those bond prices coming down, that means yields are going up. As a matter of fact, if you look at that 10-year yield, this is like this is a benchmark that a lot of companies look at and they use as far as growth. They want to see that yield get up into the 2.4%, 2.5, 2.6% where it was a few months ago. That's showing that people are moving out of that more risk-averse safety trade of buying bonds. They're selling those bonds and they're going to have to move them somewhere. That's usually a catalyst for equities. So we'll have to keep an eye on that. All right, folks, that is it for What's Hot on the Open. I'm really happy that you joined us this morning, and I hope you're getting a lot out of it. If you have any questions, email info@MarketStream.live, or you can email me directly, jcusick@moneyblock.com. All right, we'll be back at 1:30 Eastern Time. I'm going to be covering some strategies that you can look and learn about, especially if you're new, that you could potentially deploy into a portfolio. And at the least, it's going to give you some idea of what different opportunities are out there for your investments. We'll see you at 1:30 Eastern Time here for Strategy Now at MarketStream.live.